On Point with Craig's Investment Partners.
All right, morning all. Remember, as always, the information provided here is general in nature. It's not financial advice. It doesn't take into account your situation, objectives, goals, or risk tolerance. All investments are subject to risk and none are guaranteed. So before you make any investment decisions, we always recommend you contact an investment advisor. And you can find out more about our investment advisory services at our website, which is craigsip.com. Okay, let's look back on last week, and it was a bit of a mixed bag. Some markets up, some down. The US market was strong, rose another 0.9%. Those earnings results from many of the real market heavyweights continue to roll in, and for the most part, they've been very strong. So that did drive the US market higher. The S&P 500 up 0.9%, as I mentioned. The UK, Europe, Australia, all down slightly, not in a big way, down sort of 0.5% at the worst. And the local market also put in a good performance, not quite as strong as the US. We were up 0.8% for the week. So a bit of a mixed bag to end the month of April. But on the whole, it was another very strong month. You had all of the major markets rising. So investors have continued to enjoy those strong returns that we've seen for pretty much all of this year, building on some of those strong gains that we saw at the back end of last year too. So New Zealand was up 1.1% in April, the US 1.5%, Europe just shy of 2%, and the UK up 3%. Aussie was what was Aussie 1.9% up. So look, good returns across the board. And when we look at the year to date, the numbers look very strong there as well. The New Zealand market's up 4.8%. The US is up 8.6%. Europe's up 9.8%. When you throw in a bit of currency weakness, and we have seen the currency weaken against the US dollar, the pound, the euro, we've sort of gone sideways against the Aussie. But we're down quite sharply against some of those currencies, down 2.7% against the greenback, down more than 6% against the pound, down more than 5% against the euro. So those year-to-date returns that I just mentioned all turn into double-digit returns when you account for those currency moves, at least when we're talking about the US, the UK, and Europe. So all share markets are up this year. But international markets have certainly been a more lucrative place to be, partly because of what we've seen from the New Zealand dollar. So that's good. Bonds have also continued to perform well. We've seen the NZX Corporate Bond Index rise again in April, and it's up 3.7% in the last 6 months. So that's the best 6 months that we've seen from bonds since 2020, almost 3 years ago. And of course, that period was an extremely strong period for bonds because you had interest rates collapsing in the wake of COVID, which saw bond markets perform extremely well as those interest rates were cut. So that period is a very tough one to compete with, but certainly bond investors have been enjoying a strong period, just like equity investors have. US interest rates fell back last week. We had the 2-year Treasury yield in the US declining from 4.2 to 4. The 10-year US Treasury yield fell from 3.6 to 3.4, so some small declines. In New Zealand, our 5-year swap rate was very marginally down, but hardly. So you may as well just call it, largely unchanged. It's sitting at 4.3%. So it has been a good period. However, it's now May, and there is that old saying, "Sell in May and go away," and that saying has been around for a while, and it's really comes from the seasonality that we've seen in the US market in particular, because this period in the middle of the year, that our winter months, their summer months, do tend to be a bit more challenging for the US share market. So if you go back to 1950 and you look at seasonality across the market, what you find is that of the 6 weakest months, the average return for January, February, March, and so on, the 6 weakest months of the year, 5 of those are in that sort of May to October period. I think July is the odd one out. July traditionally is, a good month for the market, but the other 5 are all squeezed into that period. So I think that's been 74 years, hasn't it, that we can observe. We're in the 74th year at least. And if you look at returns through that May to October period, they've averaged about 2.7%. That's the average return of all the May to October periods for the US share market since 1950, 2.7%. And the November to April period, so the other 6 months, the average return is 6.2. So it's more than double. So that just sort of shows you, look, I mean, whether, I don't know if there's any rhyme or reason for this. I'm sure there is some seasonal logic to it, but it's not one of those things you certainly wouldn't want to build an investment strategy around. But it does seem to, more often than not, be a more challenging period. So we'll just have to watch with interest at how the next few months shape up. Right, lots to talk about in terms of things coming up and things that I observed last week. So let's start with last week, key releases, and we'll start locally. Business confidence in New Zealand remains stable. We saw the ANZ business outlook for April. Pretty good. Headline confidence virtually unchanged, still low, but virtually unchanged from the previous month. The own activity measure did improve a little bit. Again, it's well below its long-term average, but the highest since October, so that's good. Inflation indicators continued to fall, which is also positive. They're not falling as quickly as we would like, and they're still sitting at quite high levels, but at least they're moving in the right direction. So pricing intentions, which is a measure or it sort of tells you what the respondents to this survey intend to do with their pricing, looking out over the next few months. That's still elevated, but it's at the lowest levels we've seen since April 2021. Nearly 2 years ago. Well, 2 years ago exactly, isn't it? So that's good. So stable confidence and inflation indicators continue to move in the right direction. Offshore, we had some inflation figures in the US, and they again were good. It was the PCE inflation, personal consumption expenditures. This is the Fed's preferred inflation measure, largely in line with expectations. And what we saw was a slower pace of inflation. Inflation's still high, but it's slowing. And the headline PCE came in at 4.2%. So that's the lowest we've seen since May 2021. It's well down from the highs of 7% in June last year, and it's down from what we saw a month earlier, where it was 5%. So being down at 4.2, that's good news. Still too high, but going in the right direction. The core PCE, what did that do? 4.6 it came in at, which is still higher than we would like, and it's obviously higher than the headline now, because the headline is dragged down by food and energy, which haven't risen as much, whereas the core inflation is higher because it hasn't had that sort of effect of lower fuel prices and so forth. So 4.6 still too high, but again, the lowest that we've seen since October 2021, and down from a high of 5.4% in February of last year. So that's positive as well. Also out of the US, we had GDP figures for the March 2023 quarter. A little below expectations. The economy grew at an annualized rate of 1.1%. That's after inflation, so it's actually quite a strong growth rate when you think about it in nominal terms. But in real terms, after inflation, and you annualize it, you get 1.1%. That's down from the previous quarter where it was 2.6, and it's down from below forecasts, which were for 1.9. So when you look at the detail, the slowdown really did come from a fall in private inventories, and we had a fall in business investment. Government spending was quite strong. Consumer spending was also quite solid. So there's some swings and roundabouts in the air. And I guess if you were trying to look for a bright side, you'd say, look, the big inventory buildup that we saw late last year has sort of reversed a little bit, and that may be, you know, is what's driven a slightly weaker result, and sort of inventories can sort of move up and down. It's probably not something that's quite as important as the likes of consumer spending, as part of that GDP release from the perspective of, you know, what we're looking for going forward. Across the Tasman, we had some inflation figures too. So these uh, inflation fell back slightly, you know, as you've seen in New Zealand, as you've seen in the US. We saw the headline CPI increase at a rate of 7%. That was a little bit higher than forecast, actually. Forecast with a 6.9, but sort of there or thereabouts. Importantly, it's well down from 3 months earlier where it was 7.8. So they've gone from 7.8 to 7, which is good. And the trimmed mean CPI, which is the CPI measure that the Reserve Bank of Australia likes to keep an eye on, that also moderated. So that was 6.9 in the December quarter. That was the highest since 1988, actually. And that came down from 6.9 to 6.6. So again, like New Zealand, like the US, higher than central banks would like, but coming down, and, you know, positive signs in terms of that trajectory. We've got a Reserve Bank of Australia meeting this week, Tuesday afternoon, 4:30, and the market has moved to now see no change. The cash rate in Australia is 3.6%. The market sees it not changing at that Tuesday meeting, which is not where they were sort of a couple of weeks back. They saw a reasonable chance of a move this week, but now they see the Aussie central bank as staying put. So that inflation data did have an impact on market expectations. Elsewhere in the week ahead, while we're on central banks, there's a couple more. A couple of heavyweights. So that's the Aussie Central Bank that meets tomorrow, Tuesday. But we've also got the Fed in the US and the European Central Bank. So the Fed will absolutely be the highlight. That is the main event this week, the May Federal Reserve meeting. We will get the outcome from that meeting. They'll meet Tuesday and Wednesday in the US. We'll get the outcome at 6 a.m. on Thursday, our time. So get up early, have a look at the statement, listen to Fed Chair Jerome Powell talk at the press conference. Always very, very interesting, and it is often market moving. So we've seen 9 rate hikes from the Fed this cycle. The first move came in March last year. That was from a record low of 0.25, and now the Fed funds rate is at 5%, which is the highest since 2007. And there's a good chance we get another hike this week. You know, another 25 basis point hike, which would take the Fed to 5.25, the same as here in New Zealand. That is probably what's going to happen. They might not. They might pause, but I suspect they will make a small move. That could be the last rate hike this cycle. So we'll just have to wait and see, and, you know, hear what Powell says. If they do move, you know, he will be expected to sort of provide some comments about whether there's any more to come or whether it's time to pause. So could be a pivotal Fed meeting, because it could be the last rate hike this cycle, and we could get that long-awaited announcement or forward guidance to say, that's it, everybody, we're done. And if that's the case, the next move would presumably be a cut in interest rates, which, you know, markets believe is on the cards over the coming 6 to 12 months, depending on who you ask. What we won't get at this Fed meeting is a new summary of economic projections. So you won't get the the new forecasts for growth and inflation and unemployment and so forth. Those are not due to be updated until the June meeting. So, you know, we won't get that part of the picture. So, but still, look, it's this will be the highlight of the week for all of us, I think, across financial markets. So 6 a.m. Thursday, and the ECB as well in Europe. They also meet on Thursday. It'll come in the evening, our time, obviously. They are also expected to increase interest rates. This will be their third hike this year. They started increasing interest rates last year. And that ended a period of negative interest rates that had prevailed for since 2014, I think it was. So they're now at 3% for their policy rate. And they're expected to make a 25 basis point move. That would take them to 3.25. That's the highest. That would be the highest since 2008. And that was actually the peak at that point through the GFC. That's as high as they got. This time they're expected to go a little bit further. So there's still a couple more rate hikes on the cards later in the year from the ECB. But we'll be watching what they do and listening to the commentary as well. Other economic releases offshore, while we're talking about sort of Europe and the US, there is some inflation figures that'll come out of Europe, so we'll be watching those and hoping that they fall, as has been the case for inflation in New Zealand and Australia and the US. In the US, there's some big economic releases. So not only is it the Fed on Thursday morning to watch out for, but we've got the ISM manufacturing index for April, which is due Tuesday, and then the ISM services index will be due Thursday. So Tuesday and Thursday got those two ISM releases, and we've also got the April jobs report, which is out on Friday. So the ISM manufacturing index has been quite weak for 5 months. It's been below 50, so that points to contraction. It's actually at the lowest levels we've seen since the COVID period. That's been offset by the services index, which has been much more resilient and is still in expansionary territory. So we'll be watching these surveys for lots of indicators, new orders, inflation indicators looking forward, and the differences between how the manufacturing sector and the services sector are tracking. As far as the unemployment report goes on Friday, we won't get that until Saturday. Unemployment expected to increase from 3.5 to 3.6, so still very low, not far off January's 54-year low of 3.4% in the US, but we'll be watching that report too. In New Zealand, plenty going on here. We've got our own unemployment report due. This is out on Wednesday at 10:45, and that'll be the highlight, I think, for us. The December labour force report pointed to ongoing tightness in the labour market, increasing wage pressures, although there were a few early signs that things were beginning to soften. The unemployment rate here is sitting at 3.4%, so it got as low as 3.2%, a year earlier. Now we're at 3.4, so still very low, and that is expected to just push a little bit higher this week. So markets are expecting the unemployment rate to just tick up to 3.5%, which is still incredibly low. It still points to a very tight labour market, but that'll be what we're watching, and the wage data as well that we'll get at the same time will be worth keeping an eye on, because obviously wage inflation is a key piece of the broader inflation picture. So that's on Wednesday, 10:45 a.m. Before that, there's a couple of other releases. Wednesday's the day for New Zealand economic release. We'll get another dairy auction, first of all. The results of that early Wednesday morning. Last week we saw a decent gain, and that came after, it was actually the first gain in about 2 months. So that was heartening. We'll see whether prices can continue to rebound, or whether they weaken off again on Wednesday morning. And after that, that'll come out early, so after the dairy auction, but before the unemployment report at 9 a.m. on Wednesday, we will get the Reserve Bank's financial stability report, which it produces every 6 months. And this is a really interesting report. It's an overview of the key issues facing the economy, the financial system, with a bit more of a medium-term, longer-term perspective. So they won't talk about, the OCR or anything. It's more of a, is the economy in good shape, and what are the risks that the Reserve Bank's thinking about? Always lots of really interesting charts and information in it. So it is worth a read. There'll be a press conference to follow at 11 o'clock where they'll talk about that report. The last one was back in November. We get them every 6 months, so November and May. And back then, the RBNZ talked about increasing risks to the global economy, persistent inflation pressures, tighter monetary policy. They talked about falling house prices and rising interest rates and the impact that could have on households, whether that could lead to negative equity and so forth. They talked about rising unemployment being something they were quite worried about in terms of what could sort of be your worst case scenario for some households. Obviously, higher unemployment would lead to some people being in a difficult position. They did talk a little bit about the banks, and obviously we hadn't seen the bank collapses that we've seen this year, but back in November they talked about the banks, how they were in a strong position, capital and liquidity positions were sound, asset quality was high, profitability was high. So it will be fascinating to see what they say 6 months later, because house prices have continued to fall, interest rates have continued to rise. You've still got lots of risks out there for the global economy. Inflation is still a problem, even though it is starting to come down. It's still higher than we would like, and we've seen some bank collapses and issues offshore. So I would expect the Reserve Bank to be addressing all of those, talking about the housing market, talking about the ability of the household sector to handle those higher interest rates, and addressing some of those banking sector issues. And I suspect they'll give us some comforting comments around the New Zealand banking sector, the Australian banking sector, and how it is in much better shape than other parts of the world. So I would expect them to sort of provide some comforting thoughts in that regard. And the reporting season, last but not least, we've got lots more companies reporting results. So far, and this is in the US, probably half the market has reported a result. So we're kind of halfway through the reporting season, and it's been good so far. 66% of companies have beaten revenue forecasts, 79% have beaten earnings forecasts. And if you think back to before the reporting season started, so at the end of the March quarter, markets were expecting, or analysts were expecting, a 6.7% fall in earnings for the March quarter compared to the March 22 quarter. So a year on year fall of 6.7%, and now they're only expecting a fall of 3.7%, and that's because the results have been largely better than expected. So the actual results are coming in stronger than what was expected. So far so good, but plenty more to come this week. I think we've got about 160 S&P 500 companies set to announce earnings, and then there's plenty obviously from Europe and the UK and elsewhere as well. So some of the big names that I'll be keeping an eye on: Ecolab, FMC Corporation, Starbucks, CVS Health, Apple's on Thursday, Zoetis, Adidas, and plenty of others too. There's a few from across the Tasman reporting. Now that it's May, we can look forward to some corporates in this part of the world, New Zealand and Australia, reporting results over the coming month. You have the likes of Mainfreight. That's probably the biggest one. Fish and Paykel Healthcare as well. Obviously, another very large company that's widely followed. So there will be some New Zealand companies and Aussie companies that will report over the coming month. And across the Tasman this week, we've got a few. We've got Amcor, Woolworths, National Australia Bank, ANZ Bank, Macquarie, all reporting either quarterly or 6 monthly results, either interim or full year. So plenty to watch, plenty going on. It's going to be a very busy one. So before I wrap up, I did record a podcast on the tax report that we saw last week. So if you missed that, hunt it down and find it, talk to your advisor and get the report that we wrote. That's definitely a watch this space as we build up toward the election. Also recorded an interview with an Aussie fund manager about the outlook for the Australian share market. Why has it been strong? Where does it go from here? What do you like? What are you avoiding? That turned out to be quite an interesting one with some good thoughts. So that's only for clients, but I know many people that listen to this are our clients. So hit your advisor up if you can't find that, but it should be pretty easy to find if you log into the website. And I've got another podcast that I'll record later in the week on another topic. So yeah, plenty to keep an eye on, both across markets in terms of corporate releases, economic releases, central banks, as well as material that you'll be seeing come out from us. So we'll leave it there. Thank you very much for listening. Enjoy your week. Take care, everybody.
For more insights, visit craigsip.com.